To make a move like that, you have to have kahunas and conviction.
Long term, I'm bullish. We could see about a 20% correction next year.
This is Josh Jelinski, the financial quarterback. Don't touch that dial. Here we go. Sherman McClellan Financial Publications, Inc.
This is exciting. Our website for McClellan Oscillator, and there's a picture of the McClellan Oscillator every day that's available. All you have to do is log on to the website.
Fantastic. And so we're going to be talking about what everyone wants to know. Bear market, bull market, where the market's headed. Are we in a recession or will we have a bounce back? Go ahead, Sherm. First chart.
This first chart is a comparison of the QEs where the Fed is doing quantitative easing versus QTs where the Fed is doing quantitative tightening. And on the left side of the chart, we can see that the Fed was doing quantitative tightening in 2008 when they should have not been doing that. And the market was going down and went down all the way into 2009 until the Fed turned around and realized really they needed to do QE1. So when they got done with QE1, they just stopped and we had a flash crash. Well, they learned the lesson from that. So when they did QE2 beginning in 2010-11 and they stopped that, they did a little bit of not ending it so abruptly, but they still had a 19% drop in the S&P 500 at the end of QE2. Then they decided that they really needed to do QE3, and so they did QE3 from around 2013 up to 2015 area, and then they stopped doing that, and we went into a sideways problem. And if you look at the market picture, you can see that there's dips in 2016, a couple of them, and we'll talk about 2016 on another slide related to housing market at that time. And then they came along and did QT, quantitative tightening, beginning in 2018. So we had a top of the market on January 26th of 18. And then the market went into a sideways pattern for quite a long time until they realized that wasn't not doing such great things. And they loosened up and began a little quantitative easing that led to the top in 2020 in January, February, and then COVID came along and crashed the market. And then they did QE4. So now we're into QT3. And we're seeing a very big decline in the market all of this year, and we're bouncing around on the way down. Here's just a tight look at what QT2 looked like. The point here is that the bottom of the market was about halfway down the QT, so you don't get the bottom of the market right at the time that a QT ends, but you get the beginning of the up move out of the sideways pattern that is created by a QT. And here's the end of QT2 and QE4 showing the effects of the Fed raising. The scale on the right is trillions of dollars. So from the very bottom of the scale, you're at 3.5 trillion. And their balance sheet then went up to 8.5 billion in not very many years.
8.5 trillion, yeah.
So now they're trying to quantitative tighten their way out of that very large increase in their balance sheet. And we're having the effects of that. And as long as we have the effects of it, we're going to have problems with the price structure of the market. But the Fed isn't the only thing that creates a problem leading to a recession. Here's they don't have anything to do with taxes, and the Congress has to do with taxes. And there's a dotted line across at the 18% level. And when tax revenues are more than 18% or get close to it, and as a percentage of GDP, then we have a recession. And we see very poor market effects in early 2080 to 82 on the left.
This is interesting, the 18% recession threshold. So by tax receipts and by QT, are we in a recession or are we about to be?
We're going to get there, and whether are we, by some measures we've already started, but I'm going to show some more things that the Fed can do if they keep on with their quantitative tightening that will be very detrimental to the stock market and in next year. And so we're going to see what they can do to stop that or make it worse. So we're going to go take a look at that. But I wanted to show this because the Fed is not the only culprit for creating conditions for having poor conditions for the market. And we don't get the good effects of this until this is on its way down from 18 and gets down to, say, 17.5%, 17% and that's the average since 1946 is 16.5% of GDP. So when we're down in that area, we have generally a good market like we did from 82 to 2000.
So basically, if you can't see the chart, basically when we hit above 18% of GDP expressed through federal tax receipts, we hit a recession.
As a percent of GDP.
As a percent of GDP. If we go below that, we don't really start seeing an increase in the stock market till we hit about 16.5.
Yeah, until we get down lower, and we're at 19% currently.
Wow. That doesn't look good.
Now, this next chart is a comparison of the U.S. unemployment rate on the top in red and the CPI-U 12-month rate of change. And in order to make them comparable, there's a leading indication from the CPI-U of 2 years ahead of what the unemployment rate is going to be doing. So we are just now at the turning point of increasing the unemployment, and we're getting news events for the many companies laying off thousands of employees or large percentage. Twitter's laying off half their people. And so we have an increase that will be going on for a couple of years because this CPI-U is still rising, and it's up at 9%, and now the latest one was down around 7%. So I don't know what that does to the rate of change. It probably lowers it just a little bit, but we have a couple of years of rising unemployment according to what this leading indication from the Consumer Price Index is doing with its rate of change. So we're just beginning that, and we're just seeing that the economy is slowing and prices are coming. The rate of change of inflation is dropping down because of the economy is slowing. So we're going to see even more of that. So we're just on the leading edge of what it takes to create a recession and have rising unemployment. Now, this chart was created by Lars Fontaine, who does a program on YouTube for the Foundation for the Study of Cycles, which I've been a member of for quite a number of years, decades. And the red line is the cycle, and the blue line is the new home sales. And recessions take place when the cycle is going down, and the recessions end at the turning points of the cycle. Now, the next cycle low, the top was is in this year, and we're now in a down phase of the cycle until sometime around the middle to the late 2023. And So that means for me that the end of the recession would be somewhere around the third quarter, perhaps of 2023, and the market probably price structure would for stocks would bottom ahead of that. But that's when the turning point for new home sales will turn up. So we're looking at a period of new home sales being in decline for most of next year, probably half to 3/4 of the year will have declining home sales, and those are generally correlated with recessionary type of time. The other point on this is that there's a very small raise in the new home sales during 2024, and then it turns down again, and that there's a lower bottom that's created during 2025, and that ends around the end of 2025, starting in 2026, and then we'd expect to have a better market after that. So this chart tells me that we have a double dip recession to look forward to, not just a single event, and that will be only a small rise in between the current top in this year and the bottom at the end of 2025.
So do you think the recession will last until 2025?
I don't know, because it's going to be two waves down, and we'll have you can see something like that over on the left side of the chart. There's near the middle of the chart, there's a couple of double bottoms, but those bottoms were about the same level, and you can see that the bottom in housing starts, new home sales, was at the first bottom, and then it had a higher bottom at the second one. But I suspect that because this cycle is going to have a lower low on the second dip, that we may reverse that and have a worse recession in that 2025 period than we have going into 2023.
So we're looking at this chart now. If real estate is lagging and the bottom in the real estate market is 2025, wouldn't that mean the bottom of stocks could be like next year or this year, or not really?
Yeah, I think we'll have a bottom sometime around the middle of next year, and I think it'll go up into 24, and then I think that there's going to be problems with the market in 24 and 25 ahead of that recession that is projected by this cycle analysis. And of course, cycle analysis doesn't have to happen, but if looking at this chart, there's a pretty good correlation between what actually happens and what the cycles projected in the past. And this chart goes back quite a long ways.
So where do you, I know we've talked to Stan Harley, who you're friends with. He sees kind of a low point in this cycle being around New Year's Eve, and then maybe the market push higher the next 6 to 8 months. And then, kind of we begin a descent down, almost like your double dip theory, but his timing seems a little different than yours.
It is different. We have a expectation that the market is looking like it's going to continue with going up as it would in a normal third year presidential term. And that's what the presidential cycle structure, seasonal structure would look like. We think that's going to be very difficult with the Fed's quantitative tightening continuing, that will not take place, and that we'll have a dip down into December, late November, and again retest at the end of the year. So we'll show on the next chart why that's a possibility.
Why next year, the third year increase or third year decrease in the markets?
Well, a normal third year presidential term is the most bullish period that there is in the 4 years of a president's term. And the expectation is that we would bottom in November and continue up well into the second quarter of next year.
Oh, so you and he agree on that then?
We agree that that's what should be taking place. We don't agree on what's actually projected to take place.
I get you.
He's a little more bullish. I'm a little more bearish.
Okay. So you believe, when will the low be then?
There's going to be a low at the end of the year, I think, and that will go up into the early part of next year. There's some of our leading indications show that. However, we're going to take a look at some other charts down the road here that will have another aspect of what could happen. So we're going to talk about a couple of different things that can happen, and part of it depends on what the Fed does, and part of it depends on who's going to be elected to Congress and what Congress does. And so it's a much more complicated situation than any normal third year of a presidential term would normally be.
I do want to get your take on, you may talk about this, the CPI coming down this week to 7.7. Could that be something that could cause a rally? Do you have any charts on that, or not really?
Well, we're getting a rally with that. Obviously, we've had the two strongest days that we've had in a long time as a result of that. But it's not producing new highs on the S&P. It's not producing new highs on the Dow. Let me show you this chart of corporate high yield bonds AD line. And we're noted for using different AD lines from different sources.
And AD stands for advanced decline, if you're not aware, folks.
Yes, advanced decline line. So FINRA produces this data. You can go online and anybody can access it and get it from FINRA. And this is the advanced decline line for corporate high yield bonds. And it topped around October of 21. And there was some cycle stuff that said around October is really where the top of the market was. And it created a very large divergence with the January top, because this advanced decline line was considerably below its October high in January. And it came up a little bit in December to January and touched its 5% trend, and then fell away rapidly with the January decline. And it's
so the red line, for people watching, the red line is the advanced decline line. The blue line's the 5% trend. The black line's the S&P. What are the purple lines?
The purple lines are showing the S&P going up into the top in January, and the advanced decline line going down to a lower top in January. And so this divergence was a warning sign that the market did not have the liquidity that's appropriate for the price action. Later in the March bottom into April, there was a rally in stocks, which was a failing rally, and that produced a lower top on the advanced decline line, and that's showing on the purple line going down and the purple line going up on the price structure during that time. From the June bottom up to August, the advanced decline line popped up through its 5% trend, which showed some increased liquidity. And indeed, the rally into August was a much stronger rally, and the S&P recovered basically half of the decline from the January high at that time. And then it collapsed out of that August top and went back below its 5% trend and is still there currently. So we are showing that this rally that we're in now with the rising purple line on the most recent activities from the September low, and the advanced decline line is not showing liquidity driving that increase in price. And when you don't have liquidity as measured by this advanced decline line for bonds participating in that rally, the rally is very much suspect. And that's part of the reason that we are expecting that there's going to be some weakness later in the month of November, and a retest bottom in December that will then spend most of this year going down, and then we'll have a relief rally into January.
So the last few days have been positive. Has the red line broken the 5% trend yet? Or is this as of today?
It is not. It's right at it, right at the moment. I don't know what today did because we don't have the data yet.
Now, when will it push? What will make you bullish? When it goes above this trend line or not really?
I'd want to see liquidity returning in this AD line and in the advanced decline line and up-down volume lines for the New York Stock Exchange. And we're not seeing that in any credible way. And so we're going to be bearish until we have indications that we should not be bearish.
Fantastic. So what do you think I guess let's go to your next chart or whatever else you want to prepare before I go into more questions.
Let's take a look at this because this is a chart of the S&P versus the VIX. The VIX is in the I don't know what you call it, the pink line, and it has a 50-day moving average in the center, and then there's a upper Bollinger Band in green and a red lower Bollinger Band, and that's there are 1 sigma Bollinger Bands, and there is a black uptrend line that begins from
what does that
November.
mean for people don't? What's a Bollinger Band, and what's the sigma for people who don't understand what you're talking about?
It's the 50 moving average is very easy to understand. You take 50 data points and you average them, and you get a data point, and that's what we're doing with that 50 moving average.
Is it the last 50 days of the VIX?
And the last 50 days of the VIX. So that's about 2.5 months worth of data is averaged, and you get an average for what that blue line is in the center, which is the 50 moving average. And then the upper and lower bands are volatility measures for how active the market has been in the, say, around February, March. You have a very large increase in the VIX going up, and then a very large decline going down in March, and that it caused the Bollinger Bands to expand and separate. And then as we got declining from the August high, the Bollinger Bands came back together and decreased the distance between them, which is what we're seeing to some extent right now. But there's a solid black line at the bottom that goes across the major bottoms on the VIX as an indicator, beginning around last November, so a year ago. And there's a bottom at the January bottom, January top in the prices, because the VIX works inversely to prices. Or at least the normal expectation is that's the case. And so it touched that line in January at the top, and then it came down and touched it again at the March, April high. price in the low VIX, and then it came down as from the June low was a top on the VIX, and then it came down to that line, and then it went down below that line just a little bit as we did the final topping structure to the August top, and then we went back and we had a couple of retests against that line as we made little short-term tops on the way down from the August high. Now we're back down to that line, and we're just ticking below it with the last yesterday and today's action, similar to what we did in August. So the issue is going to be, are we going to stay below that line and enjoy a trending move if the VIX is below its lower band, and the lower band is around 25 and change, 25.19 yesterday, and we're at 23 today, something like that. So we might be exhausting this up move, or if we do the same kind of structure below below that trend line as we did in August, or if we stay there and trend for quite a long time as we did during the June to August advance in the market, then that's different. So if Stan's right, and we're going to continue to go up from here, and if the seasonal pattern for a third-year presidential term is really going to work, and the market's going to continue up, then we need to stay below that rising line. And if we
I think
back
he
above,
says we're going to be in a recession. He just thinks the next after we hit some low around December 31st, we might retest the October lows. We'll have a 6 to 8 month kind of reprieve in the bear market. Then it'll continue to slide down. I think that's what he's saying now. But so the CBOE vault, what does this tell us? That this
tells us that we're in an area where we're looking for a top, and rather than a bottom, or we're looking for something that will show us that we're going to really continue with the up move. And my understanding is that we need to be looking for a top around this time and into next week.
I gotcha. Yeah, I think he says around Thanksgiving is his. A little bit before Thanksgiving, he was saying too. It's interesting.